Oracle named artificial intelligence as a cause of workforce reduction in a sworn SEC annual filing, and in that same document, announced it will spend roughly $70 billion building out infrastructure in the fiscal year now underway. Most companies frame those two decisions separately, in different reports, at different times, with different management language. Oracle put them side by side, signed by the same management team, filed in the same fiscal year. That is not standard disclosure language, and it is worth understanding precisely what it describes. In fiscal 2026, Oracle employed approximately 141,000 people as of May 31st. 12 months earlier, that number was 162,000. Reuters reported the gap on June 22nd. Roughly 21,000 positions eliminated in a single fiscal year, a 13% reduction, disclosed in the company's annual filing. The filing told investors, in direct language, that the adoption and deployment of artificial intelligence across operations had resulted, and may continue to result, in reductions to the workforce. What makes that sentence structurally significant is what appears beside it in the same document. Oracle spent $55.7 billion on capital expenditure in fiscal 2026, already exceeding its own prior guidance of $50 billion. It then guided investors to expect roughly $70 billion in net capital expenditure in the coming year. Labor costs contracted, infrastructure costs expanded. Both movements appear in the same annual report. The question worth examining is not whether the job losses are large. They are. The deeper question is whether Oracle's filings describe something most corporate restructuring narratives avoid naming directly: a capital allocation model in which workforce savings function as one input to infrastructure construction, and where debt markets supply the rest. That is a structurally different claim than layoffs alone. And it raises a question the filing opens but does not close: whether Oracle disclosed this mechanism because it chose to, or because the trajectory of the internal model required it. That question will come back. To get there, start with the cost structure, because that is where the workforce reduction and the capital program connect most directly. Oracle's annual filing disclosed $1.84 billion in severance payments and other exit-related costs for fiscal 2026. That figure is up from $374 million in fiscal 2025, a nearly five-fold increase in a single year. The filing attributed the workforce adjustments to a combination of factors: management and product changes, employee performance issues, strategic business shifts, and, explicitly, the adoption of artificial intelligence. Oracle declined to specify how many positions were attributable to each cause and did not identify the affected business units. Reuters noted the company did not respond to a request for comment on the filing. The sequencing of those costs matters more than the percentage they represent. Exit costs are absorbed in the quarter they appear. Headcount-related expenses then decline from the run rate cost base, and the margin released over subsequent quarters becomes part of the infrastructure spending capacity. Oracle's model, as disclosed, funds its build-out through three simultaneous channels: debt markets, customer prepayments, and the cumulative savings from a smaller workforce. The degree to which each channel contributes is not specified in the filing. The filing names the mechanism. It does not isolate the arithmetic. The mechanism that closes the largest part of that gap is debt, and the scale of that debt is significant enough to change how it is categorized. Oracle's free cash flow for fiscal 2026 was negative $23.7 billion, as confirmed in its SEC filing. The company posted total revenues of $67.4 billion for the year, up 17%, with non-GAAP net income of $22.2 billion. That negative free cash flow number does not describe a company in operational distress. It describes a company spending faster than it earns, on purpose, against contracted demand it has already booked, and financing the difference through the debt markets. In fiscal 2026, Oracle raised $43 billion in debt financing and $5 billion in equity. Bloomberg reported in February that Oracle planned to raise between $45 and $50 billion in gross proceeds during calendar year 2026 to build infrastructure for contracted customers, including Meta, OpenAI, AMD, and xAI. Oracle's total debt now places it at approximately $117 billion in the Bloomberg US High-Grade Corporate Bond Index, making it the largest non-financial issuer in that index. Its borrowing is large enough to move the structure of the broader investment-grade bond market, which raises the sustainability question the filing leaves open and does not fully answer. Oracle's remaining performance obligations, its contracted but not yet recognized revenue, ended fiscal 2026 at $638 billion, up 363% year-over-year. Most of that increase came from large AI contracts, where customers either prepaid for GPU procurement or supplied their own hardware. Those prepaid and customer-supplied portions total $75 billion. Oracle said that amount substantially reduces the capital it must independently raise. So the contracted backlog partly underwrites the debt model, but only to the extent it converts on schedule. And delivery schedule is the second question the filing opens without fully closing. Oracle's CapEx in fiscal 2026 already exceeded its own guidance by $5.7 billion before the year ended. CFO Hilary Maxson said on the earnings call that the fiscal 2027 net CapEx figure of roughly $70 billion could run $20 to $25 billion higher once component prepayments are included, implying actual capital deployed could approach $90 to $95 billion in some measures. The Stargate data center in Abilene, Texas, Oracle's flagship facility for OpenAI, had delivered 42% of capacity as of the earnings call, with a further 35% targeted for delivery over the following 3 months. Contracted revenue recognition depends on that delivery schedule. When the schedule slips, recognized revenue moves with it. The return thesis that justifies the structure sits in the revenue line. Cloud infrastructure revenue, Oracle's segment most directly tied to AI workloads, grew 93% in the fourth quarter to $5.8 billion. For the full fiscal year, that segment reached $18.1 billion, up 77% compared to fiscal 2025. Total cloud revenue, including software, reached $34 billion for the year. Operating cash flow hit a record $32 billion, up 54%. The gap between that figure and negative free cash flow reflects CapEx scale, not operational weakness. Those are the numbers Oracle's internal model rests on. Contracted demand already recorded, growing at rates that make the arithmetic defensible, if the build schedule does not slip, and if the bond market continues absorbing the debt load at current spreads. Oracle is not the only company running a version of this model in 2026. TechCrunch published a running list of major 2026 tech layoffs, citing AI on June 22nd, the same day Reuters filed the Oracle workforce story, with Snap, Cisco, Cloudflare, Coinbase, and PayPal, each framing workforce reductions alongside AI efficiency investment or infrastructure reallocation. The pattern across those announcements is consistent. Bloomberg's analysis found that roughly half of AI-attributed layoffs may result in the same roles being rehired offshore or at lower salaries. A labor repricing story as much as a labor reduction story. What marks 2026 as structurally different from the 2022 and 2023 correction cycle is that companies are now cutting alongside record cloud revenue, record contracted backlogs, and accelerating capital expenditure. In the earlier wave, companies cut from financial pressure. In 2026, they are cutting from financial strength. That changes the meaning of the same data entirely. Before the Oracle model looks closed, 3 conditions have to hold simultaneously. The first is that the restructuring framing is not overstated. The $1.84 billion in exit costs is a fraction of the $48 billion Oracle raised in combined debt and equity in fiscal 2026. Workforce savings alone cannot explain an infrastructure program of this scale. Multiple concurrent drivers produce the headcount reduction. Performance management, product changes, and strategic shifts all appear in the filing alongside AI adoption, and Oracle did not isolate the contribution of each factor. The second is that the free cash flow figure is read in context. The negative $23.7 billion is partially an artifact of the prepayment structure. Customer-funded GPU procurement shifts the timing of cash inflows in ways that make the headline number an incomplete health indicator. Without accounting for the $75 billion in customer-funded GPU positions, the figure overstates Oracle's independent capital exposure by a significant margin. The third condition, and the most consequential uncertainty, is competitive position. Oracle is borrowing at scale to build AI infrastructure at a moment when the rest of the market is also accelerating. Amazon Web Services reported 24% quarterly growth, its fastest rate in 13 quarters. Google Cloud exceeded $20 billion in quarterly revenue for the first time. Microsoft's Azure continued expanding. Oracle's cloud infrastructure segment is growing faster by percentage, but from a considerably smaller base. The race requires maintaining build velocity while servicing a debt load that Bloomberg's index data puts at $117 billion and rising. That does not leave wide tolerance for execution delays or deceleration in the backlog's conversion rate. The $638 billion in remaining performance obligations is contracted demand, not delivered revenue. The gap between those two figures is where the risk lives, which returns to the question raised at the very start: whether Oracle's disclosure reflects unusual candor or a trajectory the internal models required them to acknowledge. In an SEC-filed annual report, the standard for what can be stated and what must be disclosed as a forward risk is materially higher than a press release or an earnings call. Companies do not include forward-looking risk language in sworn filings unless they can defend it under that standard. Oracle stated that AI adoption may continue to result in further workforce reductions. Whether that language reflects strategic transparency or structural obligation is a question the filing does not answer. The trajectory of the numbers underneath it does. What Oracle's fiscal 2026 filings describe, read together, is a capital model built on a specific premise. AI workloads will generate enough contracted revenue to service a debt-funded infrastructure build. And reducing the human labor component of the cost base is one of the structural mechanisms that makes the model function. Whether that premise holds depends on delivery timelines, bond market conditions, and whether $638 billion in contracted obligations converts to recognized revenue at the pace the model requires. Reuters reported the workforce numbers. Oracle's SEC filing documented the capex and the debt. Bloomberg tracked the bonds. The model those three sources together describe is not a projection. It is what the annual report says is already underway. Facts over fear.